Good morning, good evening, good afternoon, whenever you are watching this week's video. We are back. And this week I told y'all we was going to break down really what's going on with the passive activity loss limits. So we're going to go through it. We're going to use the IRS form to kind of break it down. I'm not going to necessarily share the form with you in this week's video, but I will make sure you have a copy of what the 2025 one looks like. So when you're looking back as to how to fill information out, it'll make sense. But before we get into it, as I'm cleaning my glasses, like the older seasoned woman I am starting to be. Y'all, I let me just say this. My kids had to tell me today that it's cicada time. Did y'all know it was cicada time? Normally, I be hearing the cicadas and then you see them dropping out and all this kind of stuff and it's crunchy. I ain't seen a lot of cicadas until I saw something on my son's car. And I was just like, what is this bug? What is this bug? He's like, Mom, it's cicadas. And then my kids be talking to me. Sometimes the roles are reversed. I'm not sure if I'm the adult. I'm not sure if they the adults. I don't know what's going on here because they be talking to me or looking at me and trying to say stuff real slick to me, like some going on with me, and I might be like 8 years old. And then I have to remind them jokers that just because I am soon to be the shortest person in my house, and I'm not short, but they just a little bit taller than me, that they have got it confused and messed up in the brain with the way that they be looking at me with the faces that I make back at me and talking to me like they crazy. So I say all that to say, if y'all know how to take knees out legally and not have to send me to the patient first because I done did something because I took their knees out, let me know. I'm here for all the tips, just like I be giving you these tax tips in these tax streets. All right. So what we gonna do is we gonna break this thing down. Now, next week on your weekly Wednesday is really like the beginning of July. So this is gonna look kind of crazy, right? So it will be your monthly newsletter. But I told y'all after this we was gonna deep dive into real estate just a little bit more because I feel like after y'all see today's lesson, it's going to make a little bit more sense that we probably need to come up with some real estate examples. So I'm not gonna take that off the table. I'm just gonna kind of flip how some stuff is done. And then what will happen is next week we will go ahead and do the July monthly newsletter because it's gonna be July 1st, y'all. We gonna be there. So we're going to talk about the things. And then what's going to happen after that is we're going to go back to real estate and then we'll start breaking down the one big beautiful bill because we are now at the end of 6 months. We halfway through. And for those of you all who are my clients that are checking in and being like, Patrice, I need to talk to you. It's mid-year. This is what's going on. I appreciate y'all. And if you don't want to schedule a meeting with me, that's your business. That's your business. However, I want to encourage you to go to your tax return, look at what your tax liability line was, the amount that you owe them people, and see if your W-2 withholdings are at least half of that, 3/4 of the way of that, so that you won't be sticker shocked because I encourage you to come and do a one-off tax planning meeting and you was like, I got it, we good, this, that, and the other, because from here on out, we going to break down the one big beautiful bill because we are all systems go, all systems go, all systems go, because everything starts to come live in 2026 and then stuff will start to trigger out after that. 2025, they gave us a little sneak peek. But I'm going to tell you, the stuff that's sliding in here, when all systems go and the floodgates are open, that whole 250-year birthday gift that is going to give to you, you're going to want to be paying attention. So tap in. Please tap in. And do yourself a favor. Send it to a friend. So that your friend know what's going on too. They ain't got to come here. But they do need to be aware to be looking at their stuff. To make sure their stuff is correct. And make sure that things are working the way they want to. And need to. And this will be my last service announcement. My PSA to you all. Understand that as we are full throttle in the AI generation, the IRS definitely using AI out here in these tax streets. They're using AI to make sure that if they want to do an audit, they're doing the circumstances, etc., around that to pick whomever. Understand that if you're using AI and learning how to use AI and prompt engineer, don't think that the government not already on it and finding different ways to leverage it. And if you are not on it, at least become aware about it. I'm not saying that you got to use it, because I do understand that it does have impacts on the environment, etc., and people feel some kind of way. But I am saying, do not put your head in the sand like an ostrich. Please do not, because certain things will happen and you need to understand that others around you will be using it, that they are passing laws to use it. They're not in an AI race to the win for no reason. So I need you to wake up as well. Let's go into passive activity loss. Y'all probably like, she done went all over the place. I just want you to be aware of it. Just don't be blindsided. Please, just don't be blindsided. All right, let's go into it. All right, so passive activity loss limits. If you fall into that category, right, where you are able to document a passive activity loss, even if you get to take it or not, the form that this gets tracked on is form 8582. And yes, we are going to be using the most recent one that exists, is 2025, as our guidelines to walk us through how things are used for this year, because 2026 is not out yet. Now, will it change that much? It shouldn't change that much, but I don't want you to not be aware of it. All right, so I am going to throw some one big beautiful bill stuff out at you, because we're in 2026. So 2025, we've closed out up through extension season, but that does not mean that you don't need to know how stuff is going to look for you that is happening live now and things that you may want to adjust from. Okay, so the one big beautiful bill adds new internal revenue code, that's what that is, section 174A, allowing a deduction for domestic research and experimental expenditures. So R&D expenses, we have videos out there on R&D. Y'all know that thing was taking me through the rabbit hole, taking me through it. So now we got some new information on there, right? These must be paid or incurred in taxpayers' trade or business to qualify. Now, I want you to be aware of something, and I want you to be aware of it very much now. Research and development has always been a thing. How it's accounted for and how it's which financial statement it ends up on is really what really is the difference that's going on. And because of some stuff, now we kind of do some retroactive with research and development. So I don't want you to think that, well, research and experimental, what are you talking about? Why did they just throw this in there? It's always been around. You got to think about it. That's how you get your prototypes, etc. How it's accounted for and where it shows up on the tax return is what's being changed under the one big beautiful bill. Now, if you have a prior year unallowed commercial revitalization deduction, it's limited by the passive loss rules. And then excess business loss. All right, so normally those would be our NOLs, etc. After applying at-risk and passive loss limitations, non-corporate taxpayers may also need to complete Form 461 to address the excess business loss limitation. And we kind of alluded to that in another week's video when we were talking about it at the top of the other line, right? Who got to file? Form 8582 gets filed by individuals, estates, and trusts. Notice I ain't say nothing about a partnership or S corporation or right, because and C corporations, they have NOLs, net operating losses. But the reason why you're not hearing it from the pass-through entities is because what happens is this type of information will show up on each shareholder or each partner's return. So the individual tax gets paid at the tax gets paid for those two entities at the individual level from the federal stance. Here's an exception. You do not need to file if all of the following apply. Rental real estate with active participation was your only passive activity. You got no prior losses or credits. Your cousin, right? Not my queen, but the cousin to the queen, modified AGI was not more than $100,000, $50,000 if you're doing married filing separately. No limited partner interest. You hold no interest in rental real estate as a limited partner or a beneficiary of an estate or trust. Now, it does have a thing down here that talks about corporations there that are subject to passive activity rules. The reason why, like I said, it gets captured on a different form. They function like corporations. C corporations, not S corporations. C corporations function like an individual, so that's why you would think it would be here, but it gets documented on a different form. We talked about our material participation test, and for those of you who are listening in the comments, what do I care about the most? I'm gonna wait. Y'all looked at that. Here's our quick reference before we get into it. What do I care about the most? Which one, if I'm doing anything, what am I telling you to go with? Y'all correct. Test number one. Test number one. We correct. Test number one. Why? Because that's my 500 hours or more. It's easy to do it. But what's the biggest thing I care about? You right again. Documentation. Documentation, documentation, documentation. Especially in an AI era, right? Because your documentation doesn't get attached to that. We just say you materially participated when we do the tax return. Now they can come back and flag it, and then when they come back, they're gonna be asking for them logs that track them hours. And so then they'll come back and they'll ask for the support. So you gotta have the support ready to go. All right? Y'all did so good. I'm so proud of y'all. I am so freaking proud of y'all. All right. Now keep in mind, spouse's participation may count as yours. For investor-only activities, reviewing financials, monitoring operations, etc., do not qualify. But go back and look at last week's video when we talk about, because we went in depth into the material participation test. All right, now for real estate. Even though we're going to do a whole breakout, this is breaking us down. Isn't that a pretty picture? I love it. Where they got it from, I don't know, but I love it. Special allowance for rental real estate. Taxpayers who actively participate in real estate may deduct up to $25,000 in rental losses against non-passive income. And so when I'm talking income, y'all know that means against your W-2 income. That's your regular other earned income. So there are rules that will allow you to take up to $25,000. Y'all have heard me talk about this in the last couple of weeks. Against non-passive income, but you got to follow certain. You got to meet certain rules. All right, y'all see where y'all phases out. Y'all phase out happens to be if you single or married filing a joint. Once we hit $150,000, boom, it's gone. It's gone. If you're doing married filing separate, once you hit $75,000, boop, it's gone. You're not gonna be able to get this. So if your income already exceeds this, then you know what's going to have to happen. You're going to have to qualify as a real estate professional. And that's when I told you I'll go back and that'll be what we discuss in detail. Well, real estate professional, what I got to do, okay? I keep hitting this. My bad, y'all. Y'all like, who is she? She messing up the slides. It's me. Up to $25,000 reduced by an allowance for the surviving spouse. That's when it comes to the estate. Active participation is less stringent than material participation. It includes approving tenants, setting rental terms, approving repairs, and similar management decisions. You got to hold at least 10% interest in the activity. So when it comes to real estate, it is a little bit easier. Let me let y'all see my face. When it comes to real estate, it's easier to be active than it is to be material. Right? What do we talk about? And material participation, which we'll go into, that's where you're going to hear my 750-hour rule for real estate. There are certain rules for real estate. Okay? That's what we'll be talking about in the next couple weeks. But it is easy for most people that own real estate and that are being a landlord, even if you are paying a property management company, most people fall into that active participation rate. It's the material participation that will allow it to be, once you exceed those limits, for you to be able to leverage that income or that loss. Leverage the code is pretty much the way I should say it. All right. Now, one or more trade or business or rental activities may be treated as a single activity. I'm not gonna lie, for real estate, that is really one of my favorite things to do, right? If they form an appropriate economic unit. But before we get into it, but the beauty behind it is it's got to be documented on the tax return. That's got to be disclosed. You can't just be out here all willy-nilly. So let's say you got a whole bunch of different units and it's all rental activity. It can be treated as one single activity. So therefore, because you like, man, I got 5 properties. I got to do 750 hours at each one of them properties. No, we can group the activities together. This rule I absolutely adore. I do. Key factors. It's got to be similar in a business type. So this is not just for real estate, but it's got to be similar in business type. You got to have common control and ownership by the people. It needs to be in the same geographic location. And you got to be aware of any interdependencies. Once you choose, right, to do this single activity grouping, it must be maintained in future years unless you didn't do it right in the first place. Okay? Or something materially in the activity changes. Let's say somebody acquires more, you sell a significant portion of your ownership, let's say because it's different trades or businesses. The IRS, however, go IRS every time. They may be able to regroup if the activities look suspicious. This is what it is, right? Here's our limitations, because it's always an exception to the rule. A rental activity may not be grouped with a trade or business activity unless the rental is insubstantial relative to the business, or each owner holds the same proportionate interest in both. Real property rentals may not be grouped with personal rental property. Rentals. And trading activities, those are my investors out here, them people in my trading streets. I love it. In which you don't materially participate cannot be grouped with any other activity. So y'all gotta do like for like. This I'll tell you again, mixing personal and business on anything. That is called commingling all across the board. I don't care what it is. And that's exactly what they're telling you. Don't be out here commingling, mixing and matching. Don't do it. They gonna disallow stuff. Wait a minute, this your personal? Like, you got to be very, 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 very sure that what you are doing, if it's a business activity, keep it a business activity. And in order for it to look like a business and function like a business, right? It doesn't necessarily mean you got to go get an LLC and you got to go get an EIN and all these things. You can go open up a bank account, right, for just this business activity. Don't be mixing it with your everyday, I'm going to the grocery store, I'm doing all the things, I'm buying the kids clothes, I'm buying myself clothes, I'm going on vacation. Don't be mixing it with that money. Don't be mixing it with those activities. Unless it has a viable business purpose, do not be doing it, because they not out here playing. I told you, AI done came in the scenes. And if you prompt something a certain way, now that burden of proof, and the burden of proof is always on you all, right? It's always on us as a taxpayer. But now you got to have your stuff in a row, because it's easier for them to catch them low-hanging fruits, because now you're doing silly stuff for no reason. Okay? I'm quiet on purpose, y'all. Passive activity income and deductions. What counts as passive income? All income for passive activities, including gains from disposition of passive activity interest or property. It excludes interest, dividends, royalties from your portfolio. Alaska permanent fund dividends, working capital income, income from covenants, not to compete, state and local tax refunds, and certain recharacterized income. Remember, passive activities are for any trade, business, real estate, anything of the nature. It ain't just rental properties. What counts as passive deductions? Deductions or expenses are, right, include losses from passive activities and disposition of passive activity. It does not include, these deductions don't include qualified home mortgage interest, charitable contributions, state and local foreign income taxes, net operating losses, capital loss carryovers, and deductions for federally declared disaster losses. Why? Because those get captured elsewhere on a tax return. They're not used to offset passive activity. You can get mortgage interest. That's on your Schedule A. You can get charitable contributions. That's on your Schedule A. You can get state and local and foreign income taxes. That's on a Schedule A. NOL gets captured elsewhere. Capital loss carryovers get captured on a Schedule D. The reason why this stuff don't offset it is because it belongs elsewhere. Not because you do not get it. That's not what that's saying. This does not say that you don't get access to these deductions. It says it cannot be set to offset passive income. Why? Because they got another place where they belong to see if they qualify for you to be able to get those deductions. Make sure you listen to that slow. All right? Between self-charged interest between you and a partnership or S corporation in which you hold an ownership interest may be treated as passive activity, income, or deduction if loan proceeds are used in passive activity. That's just a nice note that came out of the instruction. You're probably like, how does that apply to me? In most cases, it doesn't. Even for my S corporation people, don't be calling me like, Patrice, I think I did. Most of y'all interest that y'all getting is credit card interest. All right. Now, this is talking about how we fill out the form, and we will make sure y'all get a copy or a link to the form so you can see how all of this was done. You're going to calculate the passive activity loss at the top. So it'll say, hey, you earn this much in passive activity. It's either a profit or a loss, and it'll net out to what a loss is. And then we get a special allowance. You got a special allowance that says, okay, this is the section that tells us, okay, that $25,000 is sitting right there capping. Do you figure it out? And it does the calculation against the modified adjusted gross income. And then part 3 is what are the allowed losses? Because it'll bring that information down and it'll say, this is what's allowed and this is what's unallowed for the particular year. What is the benefit for this? Because when we get to the rest of the sections, it tells us how to allocate that. That allowed, to me, the most important parts of the form really are 1 and 2, 1 and 3, and then I go back to 2. The reason why is because 1 tells me, okay, what's my total, right? What is my total passive activity loss? 3 is, okay, what's going on the tax return and what's unallowed that I know got to be carried forward. So if I'm getting somebody's stuff new, and I'll let y'all see my face for this one. If I'm getting someone else's stuff new, I'm looking at it to be like, okay, do we got an 85, 82 in here? And if I do have it, hey, is there some passive loss that I got to carry forward and account for? Because it may offset some stuff depending on what that person's financial situation happens to be for that year. Or am I just adding on and building up that loss? When we get into real estate, it's going to make a lot more sense as to why I'm letting that passive activity loss grow and how I leverage that passive activity loss in certain circumstances. All right. Finally, we're going to come to the end of this week's session. Reporting allowed losses and estimated burden. Normally, they talking about how long does it take to do the form? And each form that the IRS actually has, they tell, hey, it takes about this long. Record keeping should take about 26 minutes. 22 minutes for learning the law, understanding what the instructions are, an hour and 52 minutes for preparing the form, and then 48 minutes for copying and filing and making sure everything is done. Now, does this mean that everybody doing this? Is the estimation. Some people it's going to take it a little bit longer. Some people it's going to take them a little bit less. And yes, even with software, because sometimes you're like, wait a minute, let me go to the publication. Let me figure out what's going on. What does this fall? Does this activity, trade, business, rental, does this fall into this category? And have I considered it? And do I have any passive activity losses that were unallowed in a previous year that I need to bring forward? Right. So we're putting these, right? These are the forms that they could be going on, right? Schedule C, Schedule F. Schedule C is most profit or loss businesses. Schedule F is for farmers. Form 4835, you got a Schedule E, that's for my rental property. Schedule E, parts 1 and 2, because I may have some passive loss that I need to bring forward, right? Form 4797 and Form 89 49 normally if I'm getting rid of something, if I'm selling something, that's what's going on those forms. And then entire disposition with overall gain. Okay? So there's several different things moving all at the same time that make a difference here that we want people to pay attention to. The biggest takeaways for you all is income thresholds. My cousin, modified adjusted gross income, the cousin to the queen, will phase you out of certain stuff. Passive activity loss limitation, $25,000. That's the max you would be getting. Anything that exceeds that, or if you don't fall in those income thresholds, we don't lose it. What happens is we got to do the calculation on the form 8582, and we either get to determine how much we get to have in this year and how much got to be carried forward into the next year because it's unallowed. No carrybacks, no takebacks. Carry forwards is what's happening with this passive activity loss. It does not go away. We just can only use the passive activity loss in certain circumstances. That limitation is so that we can offset it against non-passive, everybody, because I feel like everybody should stay with me, non-passive activity income. That's what we're looking for. If we can't leverage that loss against non-passive activity income, that's where this limitation come in. Then we got to capture it, hold it, carry that joint forward. Next week, monthly newsletter for July. Week after, what makes you a real estate professional? Reiteration of a lot of stuff we're talking about here. If you're a real estate professional, what does that look like? If you're not a real estate professional, boop, you're going to hear about this passive activity of loss one more again, because I need y'all to understand real estate is what? Always passive. It is a passive activity unless you fit into an exception. I am your girl, Patrice L. Berry, EA. I don't think I even introduced myself this week. Y'all know what it is. Until next week, y'all have a good one. I appreciate that y'all watched to the end. Holla at your girl next week. Peace.